I'm going to bring up the panelists. What we're going to do, since we're starting a couple minutes late, gentlemen, come on up, just grab a seat. You have a mic on each seat. I'm going to let you do your own introductions. We're going to keep them short, brief. Anyone else want to applause for anyone up here? So, there you go. Just make sure the switches are on, if you would.
Check, check.
So you can talk. All right. Little brief background. So we're going to be talking about fixed income strategies. Fixed income strategies make up 1.6 trillion of the ETF marketplace today, with the majority of that being fixed income. We have a new category of fixed income ETFs today, which is money market. So today it's a solid 42.5 billion. I'm sure that will change, thanks to Connor's company filing as well to validate our brilliance at Texas Capital for having one. So that's going to work. I appreciate that, by the way. Little background for myself, Ed Rosenberg. I've been in ETFs for 20 years. As he said, I'm the head of ETF and funds at Texas Capital. We are based in Dallas, and we have a lot of Texas ETFs, as well as the only money market ETF in existence today for like 75 more days. If you guys want to introduce yourself, please do.
Sure. How you doing, everybody? My name is Dave Sharp. I'm a senior ETF capital markets specialist at Vanguard. Really, our role is focused on the trading and liquidity piece of the ETF story and really ensuring that we're creating the best experience for our clients who are buying and selling our ETFs.
I'm Mike Schlembach. I'm a portfolio manager at Marathon Asset Management, which is a $23 billion AUM credit manager focused on public and private markets. We have a partnership with John Hancock that we're quite proud of in both private and public, and that includes a recently launched high-yield ETF that our team manages, ticker JHHY.
Does this work? No.
Here.
Thank you.
You got an extra.
Connor, did you notice that Ed cut your mic when he was going for you?
I turned your mic off, Brad. That's why it didn't work just now.
It's good you're sitting all the way down there.
Hello, everyone. Name's Brett Shealy. I'm the head of ETF specialists at Alliance Bernstein. What does that mean? It means we essentially think about how we commercialize, market, and talk about our ETF products. Before that, I spent about 10 years at BlackRock, primarily in iShares.
Awesome. Hey, everybody. I am Connor Stack, and I am a fixed income ETF product strategist at iShares by BlackRock. iShares is the industry's largest fixed income ETF manager. We actually just crossed $1 trillion in assets in fixed income ETFs globally just a couple weeks ago, which was a very exciting milestone. We have products across index, more enhanced index strategies, and then also active fixed income strategies, all in the ETF wrapper. In fact, today we have 138 fixed income ETFs just in the US here alone. So I have the privilege of working with clients and speaking to them about all of those.
Well, now that you have everyone's background, the first thing I want you to notice is they actually sat in order of how they were set up, which we said we shouldn't do, but apparently that didn't work. That's the first part. So what I'm going to do is throw a question out to everyone. Fixed income market has been growing rapidly for years, especially on the active side. It was adopted early with the first active ETF in 2008. It did disappear quickly, but because it was launched from a firm that was going under. But realistically, it's been the place where active started and really started to grow. But as you heard, index is still the largest portion at about 1.3 trillion. So my question are, so to anyone who wants to go first, what are some of the innovations you guys have noticed more recently?
Maybe I'll kick it off and just take the step back for us, which is the fact that the fixed income ETF in and of itself is extremely innovative. The fact that you can capture fixed income securities, which are inherently illiquid and expensive to own, expensive to trade, and own that via an equity security, purchase that on exchange for a very low cost, and own it for a very low cost is something that's extremely powerful for the entire investor base today. So just this entire panel, all the products that we're speaking to today is a product that is massively innovative. Since iShares launched the first fixed income ETF in 2002, you've just seen that innovation explode. There are over 800 fixed income ETFs in the US alone now today. And again, those span index strategies, those span active strategies, and everything in between. And if you look at the arc of that innovation, it has just been a continuation of democratizing more access to investors, to different segments and different sectors of the fixed income market, giving them more tools to use in their portfolio. And we would even go as far as arguing that today is arguably the best time in history to be a fixed income investor. And half of that is because of what we all know of what's going on in markets and yield levels, fixed income yields being at some of the highest levels that they've been in at least a generation. But the other half is today you have access to these ETFs that we'll discuss today to build your asset allocation strategies and construct your portfolios. So I'll pass it off to these guys to talk about what some of those ETFs are, but it has just been incredible to see the growth in AUM, in number of products, in use cases, all of which is part of that innovation arc.
Yeah, and I would just add to, I mean, there was a whole panel on this earlier, so I'm not going to bore you guys with all the details, but I think that rise of active, especially within fixed income, is going to continue. If you look at where the active ETF flows have been so far this year, like fixed income is the number 2 kind of bucket, especially within the taxable space. We definitely are seeing that even within our own book, where we've been seeing as, you know, rates are starting to come down, folks are starting to position for the future. We're seeing a bit more movement of some folks looking to move out of cash and into at least the short end of the curve. Although, you know, from today, we're also even starting to see folks move into more of the intermediate space. So it's been interesting to watch as everyone's kind of preparing for future rate cuts, how they're starting to position. And a lot of it is being done through actively managed fixed income.
And I think the question around what the innovation has been is both in the delivery and in how you put it together, right? I'm more focused on the latter professionally. But for the end client and the advisor and the allocator, just like Connor was saying, you get much more specific choice, right? And it's using derivatives, it's using portfolio trading, it's using in-kind, you know, custom baskets, all of the stuff sort of ends up like rolling out a new menu at a restaurant. It's absolute chaos in the kitchen, but by the time it comes out, you know, it's a clean new list of options and you have more to choose from as the end user and investor. And it changes the way you have to manage the portfolio. It should anyway, but it's, for me, that's a lot of fun. And how you deliver those using the new technology, using those, you know, different tools, that's really the innovation. That's where the growth is coming from, because you're able to buy a whole strip of bonds where you wouldn't been able to source those before because the passives are so big. You know, as an active manager, being able to grab those specifically out of there, or create those type of index plus strategies that have lower tracking error but still have someone minding the switch.
Yeah, I mean, I think just kind of going off of that point that Mike just mentioned, really what we look at, a big turning point in ETFs was the ETF rule that hit in December 2020. Not only did that lower the barriers of entry for more issuers to come to market, we had about 105 issuers when that rule went into effect. We have over 240 today. 1,800 products, 72% of those products launched since that rule are active. There's now more active fixed income ETFs than there are passive. That actually surprised me when I saw that number. So, you know, just seeing that growth there, but one of the key components of that is what Mike was just mentioning, it's that custom basket, that ability to bring custom baskets to really help you with the credit part of the portfolio more than anything, especially in IG and in high yield. You know, that is really important for lowering that cost to the investors and giving them an opportunity to get into the ETF at a much lower cost that's very compelling to a broader, more diversified client base now that includes more institutions as well as advised retail, direct retail, that now has this opportunity to get exactly where they want to be on the curve, or a particular style that they have within the fixed income space, and do it very cheaply, much cheaper than the underlying bonds would cost.
And Ed, maybe just to emphasize how important innovation is today in our industry, 20% of all the inflows or net flows year to date into fixed income ETFs have gone into products that launched in the last 3 years. We used to think, oh, no one can invest in this product, or no one will approve it on their platform, or, you know, we want to see a track record of at least 3 years. That's simply not the case anymore. You see a lot of the flows going into products that have launched just recently, One, because the market environment is completely different today than it was 5 to 10 years ago, and so it calls for a completely different set of products. And two, because more investors have become comfortable with, one, the ETF vehicle itself, the asset class, fixed income in this vehicle, and also just they're more willing to try new things. But the flip side of that is, and I talked about it earlier, it's such a good time to be a fixed income investor because of all the choices, but all those choices also means it's extremely complicated today, and it's confusing to decide which fund should I choose from. Of those 800 plus ETFs that are in this asset class alone in the US, how do I decide where to invest? And I think that has launched or helped fuel this other trend that you probably heard discussed on other panels today, which is these asset allocation model portfolios, which is, okay, I'm not necessarily the one to decide where to invest across those 800 funds, or maybe I could, but I simply just don't have the time and it doesn't make sense for my investor practice. So I'm going to outsource that decision to someone maybe that was traditionally an OCIO for institutional investors, but has democratized access to that asset allocation decisions to more investors through these model portfolios that folks like BlackRock and others make available to
I also
clients.
don't think, though, that advisors have to outsource their asset allocation advice. Like, I think many model portfolios are being run by the practices themselves. I'm sure many people in this room run their own practice models. I think that continues to be the dominant way. Not every advisor wants to outsource that to BlackRock or to some of the other folks. But that's definitely been a key driver of fixed income ETF adoption and ETF adoption in general.
Yeah. So
But even there, the advisor is often outsourcing to their home office or their RIA due diligence person to create those model portfolios. And even the end investor is outsourcing those decisions to their financial advisor to build that model portfolio. So you have this scale of choices that you can choose from depending on who the end consumer of those products is that's constructing those models. It doesn't just have to be BlackRock, to your point. It can be someone that's using AllianceBernstein and BlackRock portfolios to create their own broader model portfolio.
All right. Well, Connor, you touched on this, so I'm going to expand this. But the question is, you have 138 fixed income ETFs at BlackRock alone, and then you go down to everybody has them. How do the investors choose? Right? There's, if you think about it, I mean, I'll pick on your firm first, Connor, right? You've got, a 0 to 3 month treasury, then you've got like a shorter version, you've got a 0 to 1, then you go from 1 to 3 or 1 to 4, I forget which it is, then you've got like a 3 to 7. There's a million slices, right? How do the investors choose? Like, there's a lot to wade through here,
Yeah.
and that's just index. Once I go to active, it gets even harder.
Yep. So the two responses to that. One is, the first response to anyone asking where should I invest should be, what's your investment objective, right? Like, what are you looking to accomplish? And then you can go from there. The second is specific to fixed income ETFs. And ETFs are unique relative to other investment choices, like perhaps mutual funds, in that there's an extra layer of due diligence that you probably should be doing. There's the portfolio due diligence, just like you would do for something like a mutual fund or any other investment strategy, where you say, okay, what are they owning? Why are they doing it? Does it match with what my investment objectives are? But there's the second layer that we refer to as market quality, which is, okay, because these ETFs are portfolios of bonds that trade like a stock on exchange, what is the quality of that trading that's happening on exchange? What is the liquidity of it? What are the trading costs? Who are the market participants? Who are the authorized participants that are keeping that net asset value in line with the ETF market price? We have an entire team at BlackRock and at iShares called Market Surveillance that just spends their entire day looking at all of these different market quality metrics to ensure that these ETFs are trading in line with how they're supposed to be trading, and making sure that you're going with an ETF that has that high-touch market quality is extremely important.
I was just going to say it's a different criteria when you get into that ETF diligence over the mutual fund diligence. Like, one of the interesting things we found is it shouldn't be the same criteria as mutual funds. Size of a mutual, I mean, there are $5 million ETFs, being launched that at the underlying portfolio level are more liquid than a $500 million vehicle. I mean, carrying my restaurant analogy forward, like, if I'm the dessert chef, and I'm in a mutual fund and you're coming up, I get to pick what piece of the cake you get, right? In an ETF, you get a slice, of everything. And so the questions we're starting to see from the allocation, research analysts and smart RIA analysts and the like is, what about your portfolio management style and construction process has changed for those liquidity parameters? And if the answer is it hasn't, then you're just backing into some old criteria that doesn't make a lot of sense for the wrapper today. You've got to respond to the liquidity that's there.
I feel like, to your point, Mike, there's still many misconceptions and myths out there about ETFs. And one of the first things I hear from clients oftentimes is, okay, if your ETF only has 50 million or $100 million and I want to buy 10 million, like, is it going to break? And it's just like, it's not how it works. And part of our job, all of us on this stage, is to explain why that's not really relevant. And so I think when it comes to things like understanding the liquidity within an ETF, the ability to move blocks of risk within an ETF, like there are just more tools at your disposal, right, than you would have in a traditional fund or even separately managed account, that make those things sort of less important. And I don't know how we continue to battle this, but I feel like all of us have to.
Yeah, I mean, I think it's a good point. We've been talking about this for years, and just kind of what takes place in the fixed income ETF wrapper and why it's a better wrapper, but it's still a lot to understand there for clients. So we joke around that one of the roles of our team is a myth buster, and being able to go in there and talk about, hey, if this product has low ADV, it doesn't really matter. It's obviously going to be a focus for a lot of people, but when you look at that wrapper and how it can absorb new assets into the fund, you can double a fund or triple the size of a fund in a single creation, and it's not going to be damaging to the existing shareholders. So, I think it's something that is really unique to the ETF wrapper, to be able to take those baskets in and have all those assets come in a diversified portfolio in one trade. The market makers know very well how to interact with all of the major issuers and know their process, and can really, again, price it very tight. So I think that we often talk about it as a total cost of ownership story a little bit, especially in passive. Naturally in active, the alpha story becomes a little bit more important than where the expense ratio is. But when we look in the passive space, that combination of the expense ratio and your bid-ask spread is really going to give you some indications on where you might break even in one product versus another. And cost does still matter there. And what Vanguard's always said is, we're not against active, we're just against high cost active. Being able to try to replace that expense ratio with alpha becomes more challenging as that expense ratio goes up. So I think that's why we see those flows. About 43% of all the flows for the first 3 quarters went to 3% of the market that's 5 basis points or less. We still think that does matter.
I think the further you get down the quality spectrum and into things like high yield, the more important total cost of ownership is, regardless of whether it's active or passive. Because the passive strategies have to create those bond positions that come in just like the active manager does. And so the right diligence question is, regardless of strategy or function, it's how expensive is it for you to trade? 20 years ago, if the market in a lot of these fixed income markets was really narrow and really deep. You could go out and call the one guy at Bank of America and say, okay, I'm going to trade 25 million charter, 2012 bonds with you, and you're done. That same person who runs the desk now, ostensibly has a bigger job, still trades cable, and you offer 20 million, and I got to find a buyer of 20, or I can take 1 or 2, but their portfolio trading desk can take 500 million, so long as you look like a subset of the index. So as an active manager, you have to have a mind towards trading friction and how you think about turning these things around. We trade for less than 10 basis points from the mids now. I mean, I spent nearly 20 years in 1-point markets. That's crazy. And so it enables you to actually be more active. And that comes from the passives having grown so much and giving you that inventory so you can turn around and portfolio trade. It's fascinating stuff.
But Ed, to your original question, I do think in many ways it's become harder to be a financial advisor. And I say that because there is this product proliferation, not just within ETF land, which is why we're all here, but outside of it. There still is a massive mutual fund industry and complex that's out there. There's a growing separately managed account and direct indexing industry that is out there. There are model portfolios. There are alternatives, private alternatives. Like, just the amount of product that's being brought to market is enormous. And so I think it's become increasingly difficult for the financial advisor to look at each of their clients. Now there's all these things that you can use to create more custom portfolios and to say, okay, here's what I'm going to build and do it in a scalable way for more of my clients. I think it's become a big challenge, and I think it's up to, part of our job as ETF sponsors and just as asset managers to help make that process easier for financial advisors. And I don't know if we're doing a great job at it.
Look, I'm going to add to that, just so everyone knows, there's more equity mutual funds, almost twice as many than there are ETFs in existence in the US. So while there's product proliferation, there's, probably, if you add in fixed income minus the money market funds, there's way more than 3 times mutual funds than there are ETFs. And that's just mutual funds. That doesn't get into SMAs or anything else, right? So I'm going to put you guys on the spot because David brought up a point, how a lot of money's flowing into really cheap products. So my question for you guys then is, and since none of you are prepared for this, this will be fun. Do you really think it's happening because that's what's in these models today? Like if I look at wirehouse models or any of the independent models, it is the cheap beta for the most part. It's not a lot of swapping out. So not to pick on the two guys on the end, but it's a lot of your products that fall into those prices. Is that happening because advisors are using models and they're not doing a research to select themselves what's actually being used? And I'm curious of all of your opinions.
But Dave likes active now.
Yeah, of course.
I mean, he's got some.
Low-cost active.
Look, when I was at Vanguard years ago, it was half index and active. What is it, like 20% active now?
It's 20%, but it's going to grow, Ed.
We'll go with index
keep
one on
going.
that argument.
Yeah. I mean, I would say just maybe real quick to that, I think it kind of comes to the point that Brett was just mentioning of the challenge that an advisor has today and just the structure changing to more of a wrap fee. I think the advisors are inclined and almost incentivized to push that investment management role to model portfolios, to the experts. And, if we see some of the, kind of wirehouses that have a big advisor community, they're more and more using those big platforms. And that is where, a lot of our sales folks are going to focus their attention, because if you get that shelf space, it will lead to, organic growth in the product. So I think that absolutely is a driver. I think the interesting thing, with the passive active, kind of story is that a lot of passive products are used actively and the active products are being used passively. There's not a lot of, kind of trading that's taking place in active. As much as it's grown, 32% of all the flows this year have been into active, both on the equity and fixed income side. And it makes up about 8% of the AUM. So it's out kicking its weight, but it only makes up about 3% of the trading today. So, I think it's really interesting to see how will some of these models start to evolve to introduce more active into those portfolios over time. And I think it naturally should grow and will grow in that space.
It's got to come down to total cost of ownership, though. Right back to your point. I mean, all I know is high yield, right? That's where I spend my time, and the passives underperform. Many active managers underperform also on a gross of fees basis or net of fees. You start comparing it, and it comes down to, can you perform better than your benchmark net of a fee against what is otherwise accessible in that market, and how are you doing it? Because all this specialization means that unless you are talking about your fund as a go-anywhere multi-sector fund, that allocator doesn't want you coloring outside the lines. They want you to deliver that solution in that box. And so it becomes about tracking error and really information ratio at the end of the day. How much excess return over vol? And in some of the corners of fixed income, active does a much, much better job there. It's not even close.
I also think, there's a lot of talk about growth of models, and they are growing. But there does seem to be a bit of a cap. At AB, we have a private wealth arm to our firm, about 250 advisors, a little over 100 billion. And over the past 5 or so years that I've first covered them and then have worked there, we've kind of been at this cap of adoption within model portfolios, and it's been around 20%. And if you go and talk to a lot of the distributors, whether it be Merrill, Morgan, others, right? They're seeing the same thing. So there is something that's like hindering, right, greater acceleration of model adoption. And I don't know if we know what exactly it is. Maybe it's like advisors feeling like they still want to control that for their clients, that it's a part of their value add, it's a part of their customization. I think that may be a big part of it, Ed. So I don't know.
Maybe it's just a problem with the definition of models here too. I mean, there's the model universe is much broader than just asset manager models, right? There's wirehouse home office models. There's the models that an RIA builds for their entire business to follow. There's maybe a model portfolio for a financial advisor that has 5 different clients that if those 5 clients have similar investment objectives, they're going to have them in the exact same funds, and that's a model that they apply across their business. So, you know, there's certainly growth happening in model portfolios, but I think, one, it's happening broadly, not just in certain areas. And two, a huge growth area of these model portfolios, and I think one of you actually mentioned this already, is custom models and being able to take off-the-shelf models that already exist today and replace funds that are already in them with funds that you want. And maybe it's a low-cost index strategy that's in there that you want to replace with an active strategy that you have a lot of conviction in. And that's happening certainly more and more. And you know, the question itself that you asked, Ed, is almost a little circular in a way, because are these ETFs seeing the most flows because they're the ones that are in the models? Well, I mean, the people building those models are not dumb people, right? Like they're doing due diligence. They're the ones who have the time to do the due diligence on these strategies. They've decided for whatever they're looking to provide to their investors that perhaps those low-cost index strategies are what makes the most sense. And, you know, with that said, active ETFs are growing more and more. And, you know, active ETFs today, I think, make, 15% of fixed income ETF AUM, but 35% of inflows this year are going into active fixed income ETFs. And that's fantastic, because there are some tremendous active fixed income strategies out there that investors could benefit from. But the reality is that just putting an active strategy in the ETF wrapper doesn't necessarily make it good. You have to have a good strategy. You have to have a track record of outperformance. You have to have a skilled manager to be able to do that. And I'll give just one example from our platform. We have a broad high yield ETF. It's the largest high yield ETF in the industry today. The ticker is USHY. It's 8 basis points you can get high yield exposure for. Over the past 5 years, which is the longest track record it goes back for on Morningstar, it has outperformed the average high yield manager, average active high yield manager. That's impressive. We also have an active high yield strategy now available in the ETF format, but that strategy has outperformed even more active high yield managers. So there's a time and place for both, depending on what you're looking to accomplish. And it's important to have that choice for investors today.
I think the capital markets function, and I'm speaking a little bit for some of the people on this panel too.
Thank you.
With how you're welcome anytime. Put the bill in the mail. But the capital markets function matters a lot too, because Connor started talking about this. The advisor's ability or an institution's ability to utilize the trading liquidity of the very large, often passive vehicles in the ETF space and transact into smaller vehicles like what Brett was talking about. We've seen a lot of that interest in just the last couple months as we've launched JHHY, and that's something goes akin to, hey, I own a lot of passive high yield ETF X. I can swap it in. We've worked with our market maker JP Morgan or Citadel or Jane Street or Goldman or Jefferies to price that near the mids. So you can, an advisor or a large client can swap those shares of XYZ ticker into a smaller active vehicle at the mids, more or less, take advantage of the outperformance that some of us have generated over time, 3, 4, 5 years, and we'd put ourselves in that bucket too, Connor, thank you. And, and we would be able to then, when an advisor chooses to reduce their exposure to the asset class, they can flop right back into that passive and execute it, at penny spreads. And on the margin, it's also about pricing. When you have these consistent portfolio processes, your advisor, your end client wants to make sure that going through these large capital markets places of a John Hancock, of an AB, of a BlackRock, of a Vanguard, you're getting the support of those big capital markets functions for everything from those specialized trades to consistent pricing. It's really important.
I'm going to add one thing, though. You talk about swapping out models. Model providers, and probably yours as well, both yours, I know in the ends each have them. You don't want to generate capital gains for your clients. So once it's in there, you're willing to trim for a capital gain, but not necessarily replace. So even if there's something better, you don't want to face the hassle, just like the advisors, of dealing, why did you generate a gain for me, right?
I think it comes down to having active flows anyway. I mean, if you have some flows coming in and out and you're doing the custom basket and you have, in the high yield space, you get a big inflow, you get a big outflow, you can in kind on the outflow.
Yeah.
Here, yours on the stuff that's less tax efficient. The first time we rebalance our portfolio for index changes every month. The first time we did it inside of the ETF wrapper, that type of approach, when you work with the big players in the capital market space and a consistent investment process, it minimizes that. It's still present, but again, it's total cost of ownership. You don't want to get stuck in something just because it's cheap or just because you have it as a gain. Like, you want good performance, you want low tracking error, you want high information ratio, and deliver. I joke our team works really, really hard for us never to come up in a meeting with the end client.
Yeah, I mean, that's important. I mean, the other thing to think about is, Brett, you talked about models being capped. I mean, at some point, being an advisor could get commoditized. And the only way you are not is to be different than the models,
Yep.
right? Why charge a fee if you don't have to?
Right, and I think part of this too is where a model is being adopted. Like, we also see a lot of it being used within an IRA where you have to worry less about, things like capital gain. Capital gains. But to the same point, I think one of the things that advisors do add a lot of value around is helping clients think about how to dice up their book of assets. So what's taxable and what isn't, and how do you approach both of those books of money? I think it's different. And in the taxable pool, I think that's where you're seeing a lot more things like ETFs coming into play because of the tax efficiency there relative to mutual funds, but then also being used alongside SMAs, and how those two vehicles together create a very tax efficient portfolio for a client. The vehicles are being used for different reasons, but they pair very nicely. And so we're starting to see a lot of that being done, but I think it's interesting. I think advisors can add so much value for clients by helping them think about their pools of assets and how to approach them because of tax treatment.
Yeah.
So, do you want to answer?
Yeah, just real quick, I would just quickly challenge the notion that advisors shouldn't be using models, and I know that's not what you said exactly, but it's another tool for them to use to improve their practice overall. And whether it's some of their smaller accounts that they just don't have the time to do individual security selection or fund selection, say they have a very large book and a very large, some small accounts that they want to choose from, perhaps they want to use a model portfolio as a starting place, and again, then make tweaks to it. And they're still using that model portfolio there. The third point is they're still doing the selection of the model, right? It's not like they're just saying, okay, I want to go models, and they can walk away and call it a day. There's still tons of models out there that they then have to do the due diligence process on to say, what makes the most sense for my investor? What makes the most sense for their practice? Their end investor probably doesn't know how to do that either. And so that's a huge value add for them right there. And then the last thing is that oftentimes picking investments isn't the only thing that wealth managers are doing for their clients. And so this frees up a lot of time for them to focus on other areas of their business. One, maybe it's raising money and growing their book, which is good for them. But two, maybe it's doing things like tax planning or estate planning, or you're talking about taxes right now. Extremely important to be able to focus on that too. So there's a huge benefit to using model portfolios. And again, there's a spectrum to how you can use them, from just looking at them and saying, okay, I'll take bits and pieces of that, to fully using it across a number of accounts.
And I would say, maybe just to your point, Ed, just around kind of tax management around, I think the models that are sophisticated enough to think about tax loss harvest opportunities when they arise, and being able to, take that second step to the model almost acting as an investment advisor to a certain extent for some clients, could actually be beneficial. And I think that goes into the due diligence that folks need to do when they're picking a model now. What else does that provide me? What other opportunities provide? There's not a lot of tax loss harvest available right now, but in 2022, that clearly differentiated some of the models that were out there.
And the ETF wrapper helps in and of itself too, right? I think people think about it more as an equity play, but in some of the large income classes, I think Morningstar talked about somewhere between 1/8 and 1/4 of a point a year, on net tax benefit, just from being in like-for-like structures. That data is about 6 years old, but the point is that it gives you a little bit of wiggle room for all else equal, swapping, et cetera. It gives you a little bit of wiggle room for still having your client better off and being more active in each stage of delivering on their goals.
Fair. I'm going to go back to something Brett said earlier. He was talking about pairing active and index earlier, and I don't care who goes first, but this is fixed income. Replicating an index is pretty much almost impossible. So you all have to sample if you're an index. Is there really a difference between active and index? Because we talk about it all the time. We hear about it. One's better than the other. You should do this. And you guys brought up active numerous times. But what's the real difference?
Yeah, I mean, it really comes down to the objective of the ETF, right? Like, are you seeking alpha or are you seeking to replicate the index? Those are two different objectives, and I think you run portfolios differently depending on that goal. So I think there is quite a difference, actually.
If only there were two people on this panel who had written pieces on AllianceBernstein and John Hancock's website about active versus passive in high yield. We won't say who wrote theirs first. It was me. But no, we observe across fixed income, and there's one of the large consultants puts out an active versus passive report every quarter where it measures median manager performance over the last 2 decades, and it looks at median manager performance gross of fees against the industry benchmark in each subset. And what's interesting is you see a whole host of different answers depending on the subset. So question one is, does active even outperform a benchmark at all, right? And so there are places, Core Plus, they definitely do. It's not even close. Bank loans, they definitely do. EMD, they definitely do.
High yield.
No, actually. So in high yield, the median manager underperforms the benchmark by 9 basis points gross of fees, but the passives do worse. Since the financial crisis, the two large passives, the index has returned something like 100% gross. Even if you paid the index 50 bips, you'd have 96% total return. The two large passives gave you 75%. The median manager in active gave you 87. It's not 95. We can show you a few managers who have delivered that type of performance. We can talk after the panel or at drinks tonight. But I think that what you see is both relative to the gross of fees performance across asset classes and relative to what's available. Again, using that total cost of ownership model, it's not even close in especially the lower, more thinly traded places with higher amounts of negative convexity, where things can go down a lot more.
Yeah, I think, I definitely disagree with the notion that you can't add alpha via passive. In fact,
Oh, you can with asset allocation.
Exactly.
I totally agree.
Yeah, exactly.
You can get both.
Yeah.
The best investors do both.
Exactly. And for a lot of investors, 95%, maybe more, of your return variance comes from asset allocation decisions. And so getting right your asset allocation is 95% of the battle. And so if you need to use or you want to use index funds to do that, that is perfectly good approach to managing portfolios. Because again, if you don't have the time or it's not part of your practice to do all the due diligence on where does passive work, where does it not, where does active work, where does it not, and even a lot of these papers looking at active high yield relative to index high yield, they're not even using the right index funds. They're comparing things to something like HYG, which is a financial instrument ETF, not a long-term strategic holding, instead of USHY, which is that 8 basis points broad high yield product. And those are the tools that investors should be using that are looking for low-cost strategic asset allocation decisions. But then there are very good active strategies out there that you can also use. And David made an awesome point earlier, which is people are using index funds actively and they use active funds passively. You find an active strategy that you're very confident in and you allocate to that and you hold it because you know that that's a manager that can provide alpha.
Yeah, the nuance inside of the asset allocation is a lion's share of adding value. And what we've seen is a lot of allocators start to think about things in ribbons, right? So they'll take an asset class. I'm going to pick one I'm not involved in, right? They'll take one in structured credit and they'll say, this is the person who runs a low beta strategy, and here's the lady who runs a beta 1 plus a little strategy, and here's the guy who runs a higher vol strategy, and depending on where we are in the market, they'll use each. And there's a great argument for using an active here, a passive there. You can back solve for it. It really does come down to information ratio, which no one wants to talk about. It's just risk reward, scientifically, but that's really how I think you have to measure active fairly against, those type of things. I think they complement each other well.
Yeah, and talking about measuring active fairly too, you look a lot of these universes like Core Plus, for example, and a lot of them are measuring their performance against the wrong benchmarks, right? They're using something like the U.S. Aggregate Index, but they're taking on way more credit risk than the U.S. Aggregate Index.
Or cash benchmark, though, right? It's good for
Exactly, yeah. So the U.S. Universal Index, which is a broader and includes a lot of credit risk, a lot of core plus managers actually don't outperform that, and that's a better benchmark to use.
Every other one of these asset classes has something they can grab except high yield. You know, core plus, you know, manager, she or he can go grab a little more high yield. A core manager can go a little bit. I got nothing in high yield. So, you know, it's a harder space to operate in. We don't have as much of that agency problem with basis risk and benchmarks.
Maybe one thing I would just note, and stay out of the debate on the active passive structures a little bit, but just more in the kind of dynamics of how you create in those products. It's really interesting because index, you really need a broad basket. You need sometimes bigger baskets as a result to get the right mix of sector, maturity, and quality that's going to be a good representative slice of that index. So you need often a larger creation unit size, you know, and larger notional for that than you do relatively in active. Which I think is a tool that I think we'll see active just continue to look at. Hey, I could bring in $350,000 into an active structure with one unit create that's only 5,000 shares and buy a derivative to get interest rate exposure, or you know, buy some other derivative to get certain credit exposure. So I think it's going to be really interesting how that continues to evolve just in the structure to again make it as cheap as possible to the end investor by limiting what, you know, inventory management costs a market maker has to take on. So I think, you know, just the evolution that we'll see and just the way these are structured, I think, is something that we're at the forefront on and expect growth.
It definitely works for on the run. Sorry, Brett.
No,
I was just going to say it definitely works for on the run. The further you get out on the tail, though, like CDX trades like high yield until it doesn't when you most need it to not trade like it. And so it's on the tail, it becomes about what percentage of my underlying market do I need to own in order to deliver a high daily correlation or a low tracking error, right? JP Morgan's done a lot of work on this in EMD and high yield. It's high teens percentage, and then it's what percent, right? You can't have all your position diversity in stuff at 102 and have one name at 65 that's 3% of your book and expect that the create process is going to go smoothly. You have to change your portfolio construction process for the type of create and redeem activity that you see, and if you haven't, you're just backing into an old mutual fund guideline anyway.
And Ed, maybe if I could just clarify something real quick, just because I feel like iShares often gets bucketed into passive and index.
Don't worry, he does too.
Yeah, exactly. But it's not the case, right? And it's the way it is for iShares and the way it is for Vanguard. BlackRock also has a $1 trillion active fixed income business, which we now package into ETFs as well. In fact, we've been managing active ETFs going back to 2014. So we've been doing it over a decade now. We've got over 12 products that exist out there today. So it's really not active versus index. It's both, depending on when it's appropriate.
Yeah, I mean, you have two shops that are almost like the Walmart of money management, right? You can go and you can get your active, your index. They have everything. It's low cost, right? So I think what's harder now is understanding when you want to go active within your portfolio. And I think one of the things that we're doing as we're rolling out actively managed ETFs in the marketplace is thinking about where we have best of tools and technology, research, and capabilities, and trying to bring that out into the market. Our goal is not to flood with every cut of the market and leave you to make that decision, but we want to be here to provide some guidance so that you can determine where it makes sense to go active within a portfolio.
Yeah, Dave and I can do that too.
It's really important. I mean, you know, look at it. Vanguard doesn't have a high yield product, right? Why is that? It's a great question, actually. I should have thought about. No, but
All right, so I'll ask, why don't you have a high yield product?
I mean, I think, you know, really what it comes down to, the reason why we don't is that, you know, we want to make sure that we're bringing products to market that are going to be best in class. That's the kind of driving force that we want to think about. And for high yield, it's a different space that we haven't operated in. We, you know, historically had a fund that was managed by a sub-advisor. So we didn't have that expertise in-house. We have to build that, and we're building that for some of our core plus, some of our multi-sector income products that we have, you know, brought to market in the last 3 to 4 years. So the time is probably getting closer to us, you know, thinking about a high yield ETF, but it's just, I think for all the managers, you know, taking that responsibility is really important too. And I think that's something that, you know, everybody up on this stage is really thoughtful of. You want to make sure you're bringing to market a product that is going to be enduring for the client, that's going to be liquid and trade well and lower that total cost of ownership for them. It's a really important part of this story.
Yeah, and again, I just want to quickly challenge the notion that just because you're large doesn't mean you can be good at individual sectors. The active BlackRock high yield fund, 5th percentile, going back 15 years in its Morningstar category. Like, that is just incredible performance. And in fact, having the scale of a large firm can give you more resources to put behind active strategies to outperform in this asset class.
All right, look, I got about 2 minutes left, I think. Is that about accurate? Maybe less. I'm going to ask you guys one final question, and whoever answers it. We've had an inverted yield curve where overnight repos are paying the most, right? We go down the spectrum, and 10-year and 30-year are relatively similar. What should clients do in this environment? What should they look for? What are your final thoughts?
Look, I think I'll start, I think that multi-sector income, the answer isn't one thing or another, it's a lot of it. And it's, you look at the beginning of the year into now, and the differential between any of the credit asset classes, whether it's leveraged loans or high yield or hard currency EMD or structured credit using a 90-10 blend of IG and high yield rated, it's all up between 7 and 10%, round numbers. And so we get in these environments where base rates being higher than they've been in a long time, whether they are 50 basis points lower or higher on the long end, doesn't so much matter so long as we go from a curve that looks like a Nike swoosh to something that looks a little more conventional, and the ability across credit for active managers to make investments and ride that credit curve down is good for portfolio math, right? So I'm not going to sit here and jump up and down and say it's the cheapest high yield market I've ever seen. Hint, it isn't. But credit from here continues to be, and warrant a consideration in most portfolios. I think about high yield because that's what I do. 6% annualized return over 20 odd years, and we have quality names issuing 7 and 8% coupons. The future is bright for credit generally in a normal economy.
I agree with Mike, and I'm not going to tell you what you should look at, but I'll tell you what I've seen over the past 2 months, and that's been our short duration high yield ETF, SciFi. The volumes have doubled in 2 months. So,
Yeah, I'll keep this short. I mean, you can go into the whole macroeconomic backdrop and everything, but I think step out of cash, right? Those cash rates are going down. Step out of cash on a little bit of duration risk, but don't go too far. And as Mike mentioned, credit spreads are tight. So be thoughtful about what you own in credit and diversify. Diversify across securities, diversify across credit sectors. Those credit spreads are probably justified, and you get a lot of all-in yield, as Mike said. But there's a lot of other sectors you can own out there as well that you can own alongside it to protect yourself.
Yeah, I would just say, I think, it's really right. We have a similar story of watch out for where you are and on the duration curve right now, because so many people moved into the short end when you had such great rates. So, I think that is key to just think about, strategically, where do you sit? Don't sit in cash. But it's still alluring to a lot of clients. I mean, the fourth, best product by cash flows this year is short-term government product by Connor's folks down there. So, it's still there. TLT's third, but SGov is fourth. It's right in there, where people are still spending some of that money, putting it in. I think you got to be thoughtful of where you're positioned in the future.
All right. Well, thank you guys for listening. I wanted to get to questions, but we ran out of time. So,
Let's take a question.
all right. Anybody have any? You can just make it up.
We have one. Pasquale.
So, in the history of portfolio allocation, the 60-40. All right. In the history of portfolio allocation, they say that over the last 120 years, you're typically 60-40, 60% equities, 40% fixed income. Given where we are with rates today and the innovation of ETF products, what do you see happening with the 40% of fixed income, or is the complete 60-40 model gone and we're going to redefine it?
I mean, I would just say it failed in 2022, right? So I think we see things like buffered, right? We're talking about buffered ETFs, alternative asset classes. I mean, all that kind of came in because the 60-40 model didn't work. But that doesn't mean it's not going to work going forward. So I don't have a great answer, but I know there was a blip.
Yeah.
I think there'll be a sliding scale based on investor preference and age that includes a higher alts allocation going forward. You're just seeing too much of good product in tender offer and liquid format that has a different Sharpe ratio than has been historically been attainable. So don't have a direct answer other than I think the math will go into a sliding scale using alts as that third category.
Yeah, I'm going to add to that if I can. Don't forget, it failed in 2008 too, 60-40. So I think 60-40 is depending on the environment, right? That's the easiest answer.
You can keep the 40, but change the 40, right? Fixed income's a big asset class. Is that 40 high yield? Is that core fixed income? Is it T-bills? So again, just, be careful about what you put in there. Don't take too much duration risk. Diversify your credit risk.
Thank you guys for your time. If you have questions, they're open for drinks. You can buy them because they're free here, and they will answer all of your
Thank you
questions.
very much.
Thank you.
Thanks, everybody.
Thank you.